Live from the top of the Empire State Building. Get ready for the everyday entrepreneur experience. Sit back and crank up the volume. You're now listening to the Pest Equity Podcast.
Welcome all and welcome back to another great episode of Pest Equity Business Podcast. I'm your host, Vinny E. On episode 48, I want to focus on a topic that I spoke about in previous podcast episodes on other podcasts and other platforms. I want to talk about the big elephant in the room of what I call break-even analysis. But before we get to the show, I just want to give a big shout out and send my prayers to anyone that's been affected by the hurricane in Florida, North Carolina, etc. God bless you all. And if you guys need anything, feel free to hit me up. pestequitypodcast@gmail.com. Now let's get on with the show. So the question is, can break-even analysis calculate success for your business? So you may have an idea that encourages you to open a business or launch a new service or product on a little more than a hope and a dream. Or you might just be thinking about expanding a product, service offering, or hiring additional personnel. It's wise, however, to limit your risk before jumping in. A break-even analysis will reveal the point at which your endeavor will become profitable, so you can know where you're headed before you invest your money and time. Some might be wondering, what is a break-even analysis? A break-even analysis will provide you specific information for considerations such as price and cost adjustments. It can tell you whether you may need to borrow money to keep your business afloat until you're pocketing profits, or whether the endeavor is worth pursuing at all. So again, the question, what is break-even analysis? A break-even analysis is a financial calculation that weighs the cost of a new business, service, or product against the unit sell price to determine the point at which you will break even. So in layman's terms, it reveals the point at which you will have sold enough units to cover all of your costs. At that point, you will have neither lost money nor made a profit. A break-even analysis reveals when your investment is returned dollar for dollar, no more and no less, so that you have neither gained nor lost money on the venture. A break-even analysis is a financial calculation used to determine a company's break-even point. In general, lower fixed costs leads to a lower break-even point. A business will want to use a break-even analysis anytime it considers adding costs. Now, remember that a break-even analysis does not consider market demand. There are two basic ways to lower your break-even point: lower costs and raise prices. So let me talk a little bit about how break-even analysis actually works. Again, a break-even analysis is a financial calculation used to determine a company's break-even point. It is an internal management tool, not a computation that is normally shared with outsiders such as investors or regulators. However, financial institutions may ask for it as part of your financial projections on a bank loan application. The formula takes into account both fixed and variable costs relative to unit price and profit. Fixed costs are those that remain the same no matter how much product or service is sold. Example of fixed costs include facility rent, mortgage, equipment costs, salaries, interest paid on capital, property taxes, and insurance premiums. I'm sure you all get the picture. So variable costs rise and fall according to changes in sales. Examples of variable costs include direct hourly labor, payroll costs, sales commissions, and costs for raw material, utilities, and shipping. Variable costs are the sum of the labor and the material costs it takes to produce one unit of your product or service. Total variable cost is calculated by multiplying the cost to produce one unit by the number of units you produce. So, for example, if it costs you $10 to produce one unit and you make 30 of them, then the total variable cost would be 10 times 30, which equates to $300. I want to break down a term that's important in break-even analysis. That is contribution margin. What is contribution margin? The contribution margin is the difference between the product selling price and its total variable cost. So, for example, if a suitcase sells at $100 and its variable cost is $15, then the contribution margin is $85. This margin contributes to offsetting fixed costs. Unit contribution margins equals sales price minus variable costs. The average variable cost is calculated as your total variable cost divided by the number of units produced. In general, lower fixed costs lead to a lower break-even point, but only if variable costs are not higher than sales revenue. So at this point, you're probably saying, why does my business need to perform break-even analysis? Let me answer that question for you. A break-even analysis has broad uses on its own merit, but it's also a critical element of financial projections for startups and new or expanding services or product lines in your business. Use it to determine how much seed money or startup capital you'll need and whether you'll need a bank loan. More mature businesses use break-even analysis to evaluate their risk in a variety of activities, such as moving innovative ideas to production, adding or deleting products or services from the product mix, and other scenarios. One example is in budgeting the addition of a new employee. A break-even analysis will reveal how many additional sales it will take to break even on expenses associated with the new hire. The next question, what is a standard break-even time period? An acceptable break-even window is 6 to 18 months. If your calculations determines a break-even point will take longer to reach, you likely need to change your plan to reduce costs, increase pricing, or both. A break-even point more than 18 months in the future is a strong risk signal. So when to use break-even analysis? Well, basically a business will want to use a break-even analysis anytime it considers adding costs. These additional costs could come from starting a business, a merger or acquisition, adding or deleting products from the product mix, or adding locations or employees. So in other words, you should use a break-even analysis to determine the risk and value of any business investment, especially when one of these three events occurs. The first event, expanding a business. Break-even points will help businesses get a reality check on how long it will take an investment to become profitable. For example, calculating or modeling the minimal sales required to cover the cost of a new location or entering a new market. The second event, lowering your prices. Sometimes businesses need to lower their pricing strategy to be competitors in a specific market segment. So when lowering pricing, businesses need to figure out how many more units they need to sell to offset or make up a price decrease. The third event, narrowing down business scenarios. When making changes to the business, there are various scenarios and what ifs on the table at all times. That complicates decisions about which scenario to go with. Break-even analysis will help business leaders reduce decision-making to a series of yes or no questions. The third question, how do you calculate the break-even point? Well, with accounting software and managerial accounting features will typically calculate your break-even point for you, but you may want to understand what goes into that equation. Break-even analysis formula is like this, okay? Fixed cost divided by sales price unit minus variable cost per unit. So let me give you an example of break-even analysis. Lola has dreams of opening a gourmet cupcake store. She does a break-even analysis to determine how many cupcakes she'll have to sell to break even on her investment. Lola has done the math, so she knows her fixed cost for 1 year is $10,000, and her variable cost per unit is 50 cents. She's done a competitor study and some other calculations and determined her unit price to be $6 per cupcake. 10,000 divided by $6 minus 50 cents, she would need to sell 1,819 cupcakes that Lola must sell in 1 year to break even. Now, don't get me wrong, there are limitations of a break-even analysis. The most important thing to remember is that break-even analysis does not consider market demand. Knowing that you need to sell 500 units to break even does not tell you if or when you can sell those 500 units. Don't let your passion for the business idea or new product cause you to lose sight of that basic truth. Now, on the flip side, you'll need to decide how much effort and time you're willing to expand to reach the break-even point. For example, are you willing to invest a substantial percentage of your sales team's time and effort over several months to reach the break-even point? Or is producing and selling something else a better and more profitable use of time and effort? Now, if you find demand for your service or product is soft, consider changing your pricing strategy to move that service or product faster. However, discounted pricing can actually raise your break-even point. If you're not careful, you'll move more service and product faster at the lower price, but will incur more variable costs to produce more units in order to reach your break-even point. So the proper way is to plan and forecast more accurately. How to lower the break-even point? There are two basic ways to lower your break-even point. Lower costs and raise prices, but neither should be done in a vacuum. Weigh your options carefully in pricing methods and consumer psychology to make sure you don't sell more service or product or lose money in the bargain. Furthermore, consider all elements of costs, such as the associated quality and delivery, before slashing them to prevent damage to your brand. Outsourcing products or service can also reduce costs when demand or volume increases. I want to thank you all for tuning in to another great episode of Pest Equity Business Podcast. I hope this answers your question. I want to thank everyone for following us over on Instagram. For those of you who went over to Facebook and joined the Facebook group, please go on over and subscribe to our YouTube channel. And I want to wish you all the best. See you guys on the next episode. If anybody wants to be a guest, feel free, hit us up, pestequitypodcast@gmail.com. You can also shoot me a DM on Instagram. See you all on the next episode. God bless.
Thank you for tuning in to another great episode of the Pest Equity Podcast. Be sure to share, like, and subscribe. Follow us on Instagram at Pest Equity Podcast and join the Facebook group. Have a question or topic for the show? Shoot us an email at pestequitypodcast@gmail.com.